Ladies and gentlemen, welcome back to my channel. And today we have TCS, and so we will be doing the analysis of Tata Consultancy Services and an accumulate is given and sector it is under information technology. This is the CMP and this is the target. Upside is 12% and the revenue of TCS is around 1569. These are the respective uh, revenues that were generated, and whenever this thing E is given, E means estimate. Estimate is given after calculation, or we assume that it will increase by 5% if the economy is stable, or that can be increased if the economy is unstable, but TCS is being profitable. Situations are considered and then calculation is done. So we have for the holding period of 12 months. So and this is average of 10%. So for the next 5 years, average growth will be 10%. And what TCS does, what TCS is doing, that is more important for us to understand. And we have cloud consulting, we have TCS interactive analytics and insights, then we have blockchain and automation and AI, artificial intelligence, engineering and industrial services, cybersecurity, and quality engineering. And if we have product platforms, these are all the other products that TCS is involved. I am aware of this TCS ION. This TCS is ION is all the paid courses. Now if we look at that, from where the money is coming, from where do we earn? If we say from where do we earn, now banking, financial services and investments. So whatever contribution this sector is doing, TCS has many businesses under that. We have BFSI, manufacturing, communication, healthcare, retail, CPG and technology services, and other regional businesses. So this is contributing more. BFSI is contributing more towards TCS, and after that health care and life science and also retail. So if we look at the quarterly growth, life science has been performing well quarterly, and this is yearly. If we look at the yearly growth year on year, then life science and healthcare is doing a very good job. And after that, TCS stated that BFSI sector growth was powered by increasing investments and enhanced customer experience, product innovation, cloud transformation, and of core operations. Now, if we look at the geographies, TCS has been established in many countries. So North America, Latin America, and all the other Middle East countries. Now UK, Europe and India, they have grown year on year basis 29, 30, 30. And if we look at India has done a very negative thing, or India has degrowed negative 15% quarter on quarter. And if we look at MEA, Middle East Asia is doing a pretty good job, 34.4% year on year. And they are saying that Europe is expected to consolidate for a few more quarters before the growth picks up. Consolidation is like this, and then suddenly it will go up. So we are going on consolidation basis. And TCS also mentioned that a sharp rebound is likely to be happen in India in Q2 FY 2022. So doesn't mean that really India will do well. This is according to their calculation, or maybe they feel that it will take time for industry. If we look at it, India has been degrown, or even when the cash is considered, when it comes to India, it is negative 14%. Even quarter on quarter growth here is negative 15, and maybe this can happen. And also accumulate was given on TCS. That means accumulate is given when the stock is expected to do like minus 5% to 10%. Now mostly strong deals win and smaller growth and transformation deals. So TCS believes that the pipeline will continue and they will receive smaller clients and experience transformation and core transformation deals and secure borderless workspace. So TCS has invested in agile workspace and enabling company to adapt swiftly to change in the working environment. Now why they are saying just to accumulate, not to buy or not to sell, is because of the P. You look at the P currently is 40, and if you look at the P on the basis of 8 years, 5 years or 3 years, the average is 24, and now the P is 40. So the high P ratio will still continue. So high P multiples may sustain. Why? Because of upward shift in revenue and earning growths, and lower interest rate are going to also affect them. And while there will be a growth spike in FY22 after a modest dip in 21, so they are saying that in FY21 now there will be a modest dip. There can be a dip here. The company may not perform very well this year, but in FY22 there will be a growth spike, and that's why still the P will be still 40. So we see organic revenue in FY23. So in FY23 they will see organic revenue, and from the lower space being lower than FY22 but still in double digits. So in FY22 the revenue will be lower, but in FY23 it will be higher. So still they will have double digit revenue, and that's why still the P will remain 40, or P multiples will still sustain at a higher level. The results that were declared for us, this is more important. Of first quarter, this is June quarter, and if we look at it minutely, percentage of sale is 59%. Percentage of sales, gross margins and operating expenses have been 14% and gross margin 40. So by increasing the operating expense by 14%, we achieved gross margins of 40%. EBITDA margin is 25. By 21, if you compare this and this to this, here we have a loss. Quarter on quarter we have a loss of 2.6%, and this quarter we have incurred loss on profit before tax and profit after tax. You see this? So that's why, because we have incurred losses this time, we have given accumulate because it is uncertain that the next 3 months we will be profitable. We see still wanted to estimate. If you see the estimate also here in the estimate, they have seen this same calculation. They were still expecting the loss only while giving the estimate. So if we go for the while the company's wide salary hike impacted TCS adversely by 170 base points quarter on quarter, and EBITDA margins came in 25%. Year on year increase was led by high revenue growth and high offshoring, high utilization and operational efficiency from SBWS model. So that's secure workspace model. Then why not a buy? Why buy rating is not given? First and foremost because of high P multiples, already at 10 to 12 year high. Average P is 24 and currently the P is 40. So obviously we have to just hold or just keep the rating on accumulate, and there will be adverse effect on US customers because of high corporate tax if US President Joe Biden has on its way. So likely and slow organic growth is of the medium terms. In FY21 there will be a modest dip that they had said in the previous slide I had told you, and wide baskets of investment choice. So if you see, if there is TCS, there is HCL, and there is some other Sonata and other companies, Soft, you can go for them. You can also go for these companies also. And why not a sell? Why shouldn't you sell then? We see a earning acceleration in FY21 to FY24. So due to high revenue faster, we have high margin trajectory, and there can be seen that in enterprise tech valuations in US, then it compared to IT services, US are likely to rub off Indian services. So a situation where a double digit or single digit revenue could stretch beyond FY23, and low for longer interest rates, and that's why the P multiples will be elevated. So thanks, this is all I had to say. Wear mask, stay safe.